Welcome, everyone, and thank you to another session with the Stanford Blockchain Accelerator. This time we've invited Dmitriy Berenzon from 1KX. He's a research partner there to do a deep dive on tokenomics. So our format's going to be slightly different. He's going to give a little bit of a presentation, and then we'll get into questions and dive in a little deeper as well. Dmitry's had, oh, sorry, just admitting folks here. Dmitry's as I mentioned, the research partner at 1KX. He focuses on crypto research, due diligence, investments. Before that, he was research partner at Bollinger Investment Group, where he led crypto research and investments. He's worked at Coin Fund, was at Deutsche Bank Labs before that. So Dmitry is a researcher. And with that, Dmitry, we'd love to hear, I guess, your story of how you got into blockchain. But before I do, I'll just give a quick intro on the accelerator itself and myself. So the Stanford Blockchain Accelerator is part of the Stanford Blockchain Club. We are a full-time accelerator incubating teams coming out of the Stanford ecosystem, students and alumni teams. We are part of the Stanford Blockchain Club itself and are run by a team of 3 full-time folks, myself, Kuhn, and Steven, and a team of students who support us with anything and everything. So if you'd like to support the accelerator as a student, please reach out to me. Hey Gil on Telegram, or gilrosen@stanford.edu. If you'd like to apply to the accelerator, we're accepting applications for our new cohort, which starts in July 1st. The applications are due June 15th. So please, again, reach out to me for applications. I'm the one that sent you this invite. With that, let's get started. Dmitry, we'd love to hear more about your journey into blockchain.
Cool, let's do it. Yeah, and thanks for having me. Really excited to do this. It was a process. I found out about it a long time ago. 2013 is probably the first time I found out about Bitcoin. In the first few years at Deutsche Bank, a lot of what I was doing was building internal fintech products, things around real-time payments and big data analytics. And I was doing research for the bank's head of payments. Based in SF now, grew up in New York. Our offices were on 60 Wall Street, and there was the Bitcoin Center that was right near the New York Stock Exchange. So I'd go there and see people trading Bitcoin peer-to-peer and selling custom ASICs, and met Vitalik there in 2014 when he was doing the Ethereum ICO. But didn't think too much about the tech, just thought it was something that people use for certain activities online. But did see that software was eating finance, and at the time wanted to help the bank compete. So in the last 2 years there, we were building out their innovation labs. It was largely focused on frontier tech. At the time, ML was frontier, but we also did an early blockchain proof of concept in 2016, effectively using smart contracts to automate business flows. Said, okay, maybe some other use cases outside of payments, but still a lot you need to do around regulatory clarity and developer tooling. So still not bought in, and wanted to do more of a career transition, actually. So I went to Berkeley for grad school, met the Blockchain Berkeley folks, really smart. But they also had this course on Bitcoin, more from a distributed systems and game theoretic perspective. So that was finally my aha moment. It was probably late 2017. Looked at it from more of a fintech lens and said that the last 20 years of fintech innovation is effectively a pretty front end that's built on very antiquated infrastructure, often built in the 70s. And at least with Ethereum, we had 2015 Rails. So I think that was finally my moment. And then worked on a startup for about a year, and then sunset that and started to work with Coin Fund. So yeah, I think it was a long process to actually get into it, but for different people, it often clicks for them. And the interesting part about the space as it has evolved is it clicks for very different people throughout each cycle. Right now we're seeing a lot of artists, and in the beginning we've seen a lot of privacy folks. And I think each cycle tends to bring in folks from a lot of different industries, because I do think that technology is very horizontal in that sense. Yeah, I think you're on mute.
I am. Awesome. Completely agree. And it has been exciting seeing people enter, seeing who stays. But actually, I think a surprising number of people that entered in kind of the bull run speculation mania have since actually stayed and have stayed involved and know what it is, and it's created awareness and driven a lot of new technology and innovation to kind of push the industry forward. So awesome. With that, would love to kind of get into the tokenomics side of things, and I'll just let you dive right in, and we can talk questions after.
Share my screen, and can you see?
Yep.
Okay, great. So
you might want to make it full screen.
I think this is good. I tried to play around with it before. It didn't quite,
okay.
but yeah, let's just go with that.
Awesome.
So quick thing about 1KX, we are a early stage token fund. We primarily focus on bootstrapping token networks. We believe that tokens are effectively a business model innovation. It allows teams from around the world to create open source software with value accrual mechanisms baked into that software that's fundamentally better aligned between those developers, their users, and their investors. So very much crypto native, token maximalists, we like to call ourselves. And we've really been investing since 2018 across the infrastructure and application stack, from pre-seed through Series A, 1 to 30 million average checks. If you want to take a look at the portfolio, you can go to 1kx.network. What I'm going to cover today, I'm going to try to blow through this in 30 minutes. I would say if you have any questions while I'm talking, just put it in the chat and maybe we could address it later, but I'm going to move relatively fast. But I'll talk about launch timing, how you allocate resources throughout a network, how you distribute resources, how we can think about value accrual, a bit of a roadmap or blueprint on how you look, what steps you actually use to launch a token network, and what tools you can use to actually go deeper in that practice. The first question I hear a lot is, when should I launch a token? Ironically, I'll probably tell you that right now might not be the best time to launch a token. We often see not the best reasons for launching one. This could often be investor pressure. Sometimes investors need to return funds to their LPs, and maybe they don't want to wait 7, 10, 12 years to actually get that capital back. Sometimes teams launch because they don't really have PMF, product market fit, and they think a good token is going to fix a bad product. That's not the case. Some teams use it as an alternate funding source. This might be true, but I don't think you will likely attract the right folks, and you'll often, if it's widely distributed, it's a great way to get people with pitchforks coming at you when the number goes down. And yeah, frankly, short-term actors that haven't fully thought through really what they're trying to build. Why should teams launch a token? The way I like to frame it is effectively you give economic upside. You distribute it to the stakeholders that have provided the most work on your network to get you here. I'll touch upon this concept a bit later. It's really good with solving the cold start problem around coordinating the supply side of your network platform, particularly if it relates to some kind of hardware, and also aligning incentives between folks who might not have actually worked together previously. The answer here is it largely depends. So if you're launching a hardware resource provisioning network, this could be around storage, compute. For example, you might want to launch something sooner. You often need a way to coordinate nodes to provide some resources. You might need a way to actually meter the resource usage, like you have gas for Ethereum. So that often makes sense. If your competitor launches a token, you might need to shift your timelines. Tokens are really good at actually taking away market share. If you have a governance, if you're planning on launching a governance token, I would say this could probably wait until you have a better sense of really your where you are in PMF. If you want to launch a utility token, but it's not a hardware resource provisioning network, I might ask if you really need that. I'll touch upon this later on. We're not fans of utility tokens in the sense of payment tokens. I think it adds a lot of friction to the end user, and to the extent you can avoid that, that's probably a good thing. My mental model is the less you need a token to deliver your end product service network, the more time you can wait before launching. And two questions I like to ask is, does your project have PMF, and does it have on-chain value flows? The latter is particularly important when it comes to token value accrual. A very simple matrix. Basically, if you have PMF and you have on-chain value flows, I think it's fine. You could consider launching a token if it makes sense for your project. If you don't have either, it's a very bad idea. And then we get into more of the gray area, where if you have, for example, PMF, but you don't have on-chain value flows, you can launch one, but you might take price risk due to limited value accrual. And if you do not have PMF, but you have on-chain value flows, then maybe, but once you have a live token, it's typically more difficult to pivot because you have a large community and you need to really cater to all these individuals, and it makes you effectively move slow. So I would just think about that. Resource allocation. Two main questions here. Who do you want to distribute resources to, and how do you distribute resources throughout the network? One way we could think about a network, the way we like to think about it, is it can generally be modeled as a marketplace, where you have a supply side which delivers some product or service, and a demand side which consumes our product or service. And that supply side can vary. It could look very different. This could be GPUs or some kind of hardware resource. This could be liquidity. This could be services like providing content. And the demand side can look also very different. This could be traders or players for your game, or subscribers for your service. In the context of time, let's assume you know what you want to build, and you know what each of these roles are, and you modeled out the desired behaviors of these roles. Okay. So once you've done that, then we can start to think about how you define the token mechanisms required to incentivize those behaviors. One concept we like to think about is the notion of sinks and faucets. We think that token networks are also like economies. So one can reframe the design as creating sustainable economies of sinks and faucets, with sinks being value flowing in out of the economy, and faucets being value flowing in. Here are a couple of tools you can use. I think we're very familiar with things like airdrops, or you distribute tokens or individuals to individuals that have interacted with your protocol. They need not have to interact with your protocol. For example, Handshake did an airdrop to Gitcoin handle, GitHub handles. You could inflate the supply and sort of distribute that to different folks on your network. The notion of work we think is very interesting. Like I said, there's a lot of different flavors of work, but you could effectively distribute this to people who do financial work, like provide liquidity or make markets. You could distribute tokens to people who do some kind of software related work, like run a node, participate in consensus. Hardware around provisioning some kind of storage capacity, maybe generating ZKPs, and even some services like voting and governance. And you can also do things like community grants, bounty programs. These are effectively ways to introduce tokens into your economy. There's many ways to take them out of the economy. Burning, very straightforward. You send it to a one-way address. We like the notion of staking. I think it's a very powerful concept of effectively having economic skin in the game. And you could have a lot of creativity with what you do in return for staking. You could do things like stake to vote, like what Curve and Urine does. You could do stake to earn, like GMX or Sushi. You could do stake to save, like BNB, which gives you fee discounts. Stake to secure in the context of proof of stake protocols, which quite literally you're staking to secure the network in Ethereum or Osmosis. And you do stake to underwrite, like in Aave, for example, where you stake and that stake is used to backstop the protocol. So we really like this kind of tool. Lockups we often see in the context of vesting schedules, but you could also do some interesting things like the VE model. We've seen some Curve where you lock your token up for some period of time and you get some reward for doing that. Protocol fees, pretty straightforward. You pay ETH because you want to interact within the Ethereum network. And oftentimes people do this, teams do this by also buying back tokens and removing them from circulation. Okay. The next concept is carrots and sticks. So apparently this is how they had donkeys carry things back in the day. You dangle a carrot in front of them, they walk towards the carrot, they stop walking, you hit them with a stick. You could think about this when trying to incentivize behaviors within your network. A lot of different carrots, oftentimes inflationary rewards, token emissions are very powerful here. You could give them access to some revenue flow. You could give them voting power, and there's often softer kinds of carrots like reputation or access to something on-chain or even off-chain. In terms of stakes, you could dilute their stake if they aren't participating in the network actively. You could slash a portion or all of their stake if they're doing something malicious. You could exclude them from participating in your platform or service, either temporarily with timeouts or permanently with sanctions. And there's also negative ways to do reputation, like distributing a sold down token. Okay, I'll touch on network distribution. How do you distribute tokens to those adding the most value to the network? Ideally, what you want to do is incentivize the folks who have taken the most risk in the beginning. The way we usually do this is by distributing more tokens to the folks early on and have some cascading function over time. The issue is that we now have the act of being the humble farmer makes it actually very difficult to figure out who are your early users and who are the individuals in the system who know that this is likely going to happen and so are unlikely your long-term users. And it's very difficult to not have this because, and I haven't really fully figured this out, but you need initial liquidity, you need initial token float. Airdrops are actually a really good way of getting that initial float, but it's become really hard to filter. Two suggestions I would have on this. One is unique mechanisms. What worked for one protocol is unlikely going to work for another because those behaviors then become learned. A couple of examples, back in the day, July 2020, I think around there was DeFi summer. Bottom right is Yearn. That shows the steps you needed to effectively mine YFI tokens. This was not an airdrop. This is more of a liquidity mining program. The interesting part was that it was so complicated that very few people knew how to go through all those steps, but that was actually a very aligned distribution because the people who ended up doing that were actually the right shepherds of the protocol, largely. Optimism had some cool ideas. They had this notion of eligibility criteria where they looked at, are you an Optimism user? Are you a DAO voter? Did you donate to Gitcoin? And based on that, you effectively got a scorecard for how many OP tokens you can claim. The second point is small and consistent rewards instead of one lump sum. You effectively accept that airdrop hunting is standard user behavior, and you lean into that fact and effectively dangle carrots in front of users until they're fully engaged with your system. This is not very different to how Uber subsidized ride costs to effectively make it a lifestyle choice for people. Blur did this really well. They had this notion of seasons, and each season they distributed a percentage of their supply. Interestingly, they did not even say what percentage of the supply. They just said you're going to get some tokens, and in the next season, you're going to get some multiple of tokens. So people didn't even know if they were going to get, $100 worth or $1,000 worth. But it was very powerful in actually keeping users engaged, and they still have a very strong hold on that specific user cohort that they were targeting. So I think that works very well. Distributions, fairly straightforward. Left-hand side is a survey that someone did. Right-hand side is some napkin math we did of some examples we like. TLDR is usually half of the supply goes to the treasury. Not super sure why the industry arrived at that shelling point. It could be things around being community focused. Maybe there's a regulatory component. I'm not a lawyer. I've heard investors say, well, the community doesn't know what to do with 50% of the supply. I don't particularly disagree, but I think that is more of a function of better DAO design. But I think that's probably a separate conversation. Roughly, we see the distributions from 18 to 25% each for team and investors. For airdrops, I think the goal that we try to recommend our teams is between 8 and 12% float. You can have a portion of that from the airdrop, but we actually prefer to have more of the tokens circulating in the beginning because a large supply overhang is usually not good for your early believers, effectively. Emission schedules also have become pretty vanilla. Left-hand side is Uniswap, right-hand side is some napkin math that we did also on a couple of examples. Most we see is 4-year emission. Some teams have terminal inflation with the Uniswap as 2% terminal inflation after 4 years. We've roughly seen similar, I would say between 80 and 100% are emitted after the first 4 years. In some models, we see potentially another 20% emitted from, say, year 4 to year 8. I personally do like some small amount of inflation because I think it could be effectively a faucet and a carrot to incentivize either your supply or demand side. I'll touch on token value accrual. How do you drive economic flows into your native token? The market hasn't figured out a specific and agreed upon way to value tokens. This has been an issue for years, and I don't think we're going to arrive there anytime soon. So what I could do is provide you with some tools, with some rather framings on how investors think about features that your token model has that might lend itself to value accrual at some point in the future. The most obvious is you reduce the amount of tokens that are available. If you reduce the token supply, floating, circulating, or total token supply, the idea is if there's less tokens available and there's equal or more demand, that tends to give more upward price pressure. It's probably a good thing. It could be claims to treasury or revenue. I don't think you need to actually have done that claim, but you want the ability to do it. For example, Uniswap does not turn on a fee switch. It has not actually distributed claims, but it is the market belief that they might do so at one point that I think gives people comfort. Store value is usually very difficult to get to, but very powerful if you do get there. There's a lot of factors that contribute to becoming a store of value, things like scarcity, security, stability, trust, and adoption. I would also note that you could also have NFTs that can be a store of value. It need not be fungible. I think CryptoPunks are actually a pretty cool example. Buy pressure, pretty self-explanatory. People want to buy ETH to transact in the Ethereum network. That becomes very powerful over time. And my own personal favorite, tokenized goodwill. This isn't really talked about, but things around brand, reputation, who the founders are, who they know. It took me a very long time to understand why Doge had value. And I frame it as the effectively the societal belief that dogs are valuable. And I think that the power of memetics is not to be underestimated. This actually drives a lot of perceived value accrual by the market. So putting it all together, here's how I look at a roadmap from start to finish of how I would go about creating a token. Steps 1 and 2, I assume you've already done. You know who you want to, you know what you want to build and who you're building it for. Step 3 is you start to think a bit deeper about who is each agent and what are the desired behaviors you want for each of those agents. Step 4, I didn't talk about this too much, but ideally, if you can avoid, or let me positively reframe it, if you could find ways to enforce behaviors mathematically or cryptographically, that's probably better. It typically is more sustainable. We tend to, in the security concept, for example, we prefer cryptographic security over cryptoeconomic security. So if you have ways to do that, zero knowledge proofs, for example, a very powerful mechanism, I would do that first. But then there's going to be behaviors and cold start problems that you cannot solve with that. And there you can use a couple of these tools that I've outlined around sinks and faucets, carrots and sticks. After that, you could think about initial token distribution, and then model and optimize its parameters. I'll touch upon that in a little bit. One question I get a lot is, what does a good token model look like? I am reluctant to give you examples of individual tokens because outside of ETH, I don't think anyone does it perfectly, but you could often have guiding principles that work well. I split it between infrastructure and applications just for simplicity. On the infrastructure side, one very important piece is, can you cover the initial capital expenditure costs and operating expenditure costs for the supply side? For example, if someone is providing GPUs for the network to do some compute, you could think about how much does an initial GPU cost for them? Are there any ongoing server costs throughout the year? Say in general, it's $5,000 that anyone will spend per year. How can you back out that value based on some anticipated token price and effectively give that to them in the token? Because then those GPUs on the network is the thing that you actually need to provide the service. Ideally, though, you have actual demand and willingness to pay from some user. So these subsidies should effectively not continue forever. Second point, really important. Ideally, it shouldn't degrade performance. Ideally, it should be at par, and that's already difficult because if you are building a decentralized system, you are already introducing redundancy for fault tolerance. So that's a really hard one. But ideally, your token doesn't add unnecessary friction there. Third point is supply side economics scale with increasing usage. You have the ability to effectively incentivize new machines or new liquidity that comes online. And ideally, you have some form of elasticity there, where if you have a decreasing, supply, then your token emissions reflect that you give out less. On the application side, ideally, it's a function of organic usage and retention. I think to the extent it creates community engagement, people want to actively participate in governance, build on top of you, integrate with you. I think that's very powerful. This is a mouthful, but if you can create repeated and path-dependent economic gains amongst participants, I think that's also particularly interesting. One good example is this VE model. Like what Curve does, you lock your tokens up for some period of time, you start to create very interesting games amongst those participants, which could also be DAOs or funds themselves. That actually tends to be a really nice magnet for attention and liquidity in particular. On both sides, again, to the extent you do not introduce friction to the end user, that would be great. Blockchains are already very difficult to use. So if you are having your user jump through another hoop to acquire a token to use your service, that's probably not the best idea. We believe fair distribution is very important, not just to early users, but also to your investors and your team, to have that be balanced. This is a controversial one, I suppose, but reflexive security is probably not good. It's quite literally unavoidable in proof-of-stake networks like Ethereum. The thought experiment is, what breaks if your token is worth 0? To the extent you could find other ways to bootstrap, particularly security, I think that's probably healthier, because if there's anything we learned from last year, we should stop having retail get wrecked and lose money. And reflexive security models are one way of doing that if things really go in the wrong direction. And having something that contributes to governance effectively to make people feel like they are incentivized. What are some common mistakes? I kind of just mentioned this. Reflexivity is a powerful flywheel, but you ideally want to get to the place where there is sustainable organic demand. The unit economics, you cannot just distribute tokens forever. Again, there needs to be some willingness to pay from the demand side, and that's kind of the work that you need to do upfront and actually talk to who your demand side is and try to figure out what their willingness to pay is. Too much governance. I think this is also a trap for teams that have a live token. We think a lot of these governance models and these DAOs today are broken. It's very political. It takes a lot of time away from actually building a service or a network. Public token sales, we are not a fan of. I think one of the most important things with tokens is who do you want to be owners and stewards of your platform protocol service. I think the channels that a lot of these public token sale platforms use, it probably is not those individuals. They will likely be a bit more short-term focused. And particularly one thing that we've seen in the last bull market is launching with low circulating supply. Probably not a good idea. I think it hurts your early users. I mentioned this before, and your early supporters. I would rather have there be a decline in price over the first few weeks, because then that gives the ability for people who are excited about what you're building to actually have buy-in, and then everyone gets to benefit for when you actually find traction later on.
Dmitry, one quick question there. Can you just elaborate a little bit more on reflexive economics for those that might not be kind of have a depth of understanding there?
Yes. So one example is if you are distributing incentives for liquidity mining, you are basically telling a liquidity provider, for every dollar of capital that you provide me, how many dollars worth of my token are you getting? And the more your token is valuable, effectively, the more dollars you have at play. And so as your token value increases, you attract more capital, which likely shows that your protocol has more traction, and that flywheel continues. I think that is probably okay in the liquidity aspect, but where I particularly worry nowadays is when you have that in the security aspect. If you have some token that underpins the security of your protocol, say it's a bridge, you could have a downward spiral there where, okay, if your token is worth 0, then what incentive is there to prevent your validators from taking the funds and running away? And yeah, ideally we want to avoid that because there might be a lot of funds at stake. Yeah.
Awesome, thank you.
Yeah, and then lastly, 2 tools that could be helpful. Machinations, this is actually used in game design. I think it's a pretty cool tool. A bit difficult to get a grasp on initially, but I think it's helpful. This is an example of how an AMM can be modeled, but I think it's a nice way to visually represent a lot of the flows that happen throughout your network or economy. I think it's pretty digestible. It'll take a few weeks maybe to get a handle on it. And CatCat, this is an open source Python package that assists with agent-based modeling and economic simulations. For those not familiar, agent-based modeling effectively defines some set of actors, and it gives each actor their own rules and behaviors. And it runs simulations to understand how each of them interacts with each other and shapes the behavior of the overall system. This is particularly helpful for uncovering potential vulnerabilities or scalability issues, or thinking about optimal resource allocation for your network. I personally don't do this, but we have Robert on our team who's a financial mathematician who tends to do this. I think it's a cool way to tighten the design later on, especially if you're building some infrastructure network. And that's it.
Awesome. That was incredibly helpful. It was a lot, but no, that was awesome. I've got a bunch of questions, and then I'll let other people, as they have questions, also write to the chat and kind of pick a couple. So if you have a question, please feel free to write to the chat. Dmitry, earlier in the presentation, you mentioned a little bit about kind of you weren't a fan of tokens for utility. Can you speak a little bit more about that and what you meant by that?
Yeah, I think when I think of utility, there is the notion of a payment token. Like imagine you are in a desert and you've been lost in the desert for 3 days. You're super thirsty. You find a lemonade stand and you're really thankful, and you go to and you have a $20 bill in your pocket and you give it to them, and they say, oh, sorry, we only accept lemon coin. And you're like, what do you mean? They're like, I have dollars. And they're like, no, sorry, only lemon coin. I think that's probably not a really good experience for an end user. So I don't like payment tokens because it's typically really difficult without proper on-ramps for individuals to acquire that payment token. And frankly, if they have, in the ideal state, they have dollars or ETH, and that makes it much easier. There's also interesting developments that are happening around account abstraction. I don't know if anyone has read into that, but there's this notion of a paymaster contract. This paymaster contract, one thing that it does not specify is what it can take as payment. So it's actually unopinionated. It could take ETH, it could take credit card, ACH, SOL, NFT, whatever. I think that's a very cool mechanism for onboarding users, because you allow them to pay with whatever their form of payment is. The two exceptions I'll say is, again, hardware resource provisioning networks. You could think about another example is application-specific blockchains for provisioning some resource like Filecoin or Arweave. There, a utility token often makes sense because it incentivizes the supply side, and also game economies. Maybe if there is a way to introduce a payment token in a way that's sustainable, there's already learned behavior with games and users knowing like there's in-game currencies. So maybe there's opportunities there, but I one thing that we try to suggest is if you can avoid it, then it's probably a good idea.
Gotcha. So it makes sense. So it's more the frictions of getting people to actually use the platform and gain the utility that's added by having this token that kind of disincentivize people from doing that, and that slows overall adoption or participation in the economy itself, which is what you're against. So I guess in theory, if you are able to solve these kind of on-ramp, off-ramp challenges, then there could be I guess if you have a multi-sided marketplace or an ecosystem of people that you're trying to coordinate amongst each other, certainly makes sense for some to not be token based if that's going to reduce friction, and others to be, and kind of thinking of how to onboard more versus less people.
Yep.
Okay, awesome. And then in terms of token supply specifically, so you kind of mentioned that you're not a fan of public token sales. Just to clarify, that's public token sales specifically, but public token listings for liquidity purposes you are, and if so, kind of how do you view managing the proportion of token holders that are potentially quote unquote speculators required for creating liquidity for people using whatever hardware or et cetera, participating in the platform, versus ensuring that they're not the primary ones driving price, and it's actually the primary participants that drive the actual price of the token?
For sure. I think liquidity is important. I think there's also a regulatory aspect here. I mean, what you should probably not be doing is like going to an exchange and then having a contract with a individual exchange. If you do want to engage market makers, that's probably more okay. But a lot of there are other ways to get liquidity. I think speculation is not a bad thing. My primary concern with token sales is what percentage of your supply is going to those speculators, and at what stage. I think it's fine to have them play with it, but ideally, I give that initial supply to the right people. So one, I think, really good example is ApeCoin. With the Bored Ape holders, no one was expecting to receive ApeCoin. And so it was actually a pretty immaculate drop. And if you looked at the price action, it was really cool because there was a lot of potential sell pressure, way more than what we usually see. I think it was maybe like 20-25% float. Don't quote me on it. But there was actually not a lot of sell pressure because the ape people, like, they have the JPEG, they'll take the coin too, you know, like it aligned very nicely. But if you're giving it to someone in, I don't know, Eastern Europe, you know, who participates in that sale, like, what do you think they're going to do when it unlocks? You know, so I don't know, like, if that answers your question.
So it does, and I guess more asking, like, from a detailed perspective, and you know, approximately what proportion of a token supply do you think is acceptable to be allocated more publicly for speculators, so to speak, for those liquidity purposes? Is that like 5%, 20%, 50%? I think by and large, many of the projects we have now, probably the majority of the tokens are in the hands of speculators versus users.
Yeah, it's hard to answer. I mean, another way to reframe it is, what percentage of trade volume are you expecting to have, a daily trade volume? And then you count what the 2% slippage is for that trade volume, and you create some pool on a DEX that's equal proportion, either like ETH or USD and your native token, and that's effectively a way to provide that liquidity. So it really depends on how much trade volume you think you're going to have.
Gotcha.
Yeah, but it's hard to put a specific number on it.
Right. No, that makes perfect sense. So figure out how much liquidity you'll actually need, and use that as a metric to help seed that. Quick question on Dogecoin. So you mentioned that you've been impressed by the power of memetics for tokens that are non-purely memetic based, or such as Dogecoin, or many of the other kind of more social NFT coins, or utility tokens. Do you think having those memetics is beneficial or harmful, I guess, to the same point that we had in the last question, where it's driving supply towards people that you know, aren't necessarily participants, but are just, you know, they like it or they don't like it, or they're trying to make money off of it?
Yeah, I mean, I don't think it's a bad thing. Like, I am not against speculation from like a philosophical perspective. I think what's happening like with Pepe is super interesting. You know, like, maybe that is the tokenized brand value of the green frog. You know, like, I don't have any, I'm not going to participate in it, but I could see how people like that. There's other, you know, like, memetics often provide a selling point around a vision. You know, with Arweave, the notion of storing something forever, I think that's like powerful for people. I've spoken with some folks that say, well, like you don't need forever, like maybe 10 years is enough. Well, maybe, but maybe there's other people or certain use cases that actually value the notion of forever. You know, so I think it's often ways to actually like communicate the value prop and to build virality as well.
Awesome. Gotcha. So generally thinking of it from a marketing perspective, and who you're marketing to and how you're marketing to support customer acquisition and engagement in that aspect. But again, unless you're actually creating enough value for the people that hold it, then similarly, and you know, you just end up with churn, and that creates downside pressure, which we don't necessarily like. Cool. And then you mentioned something around cryptographic security being better than crypto economic. I think that makes sense. And ZK proofs are kind of a great example of cryptographic security. But you kind of mentioned that there are some challenges with cold starts. Can you explain a little bit more what you meant by like challenges with cold starts and using cryptographic security?
Oh, sure. I'm not sure if they're fully related, but say you're starting a NFT marketplace.
Okay, gotcha. So those were two separate concepts of just you in general have to worry about cold starts.
Yeah.
Okay,
I think
cool.
there's maybe if you are starting, say, a new Cosmos chain, you have some validator set, like you need some security. You need a bunch of nodes that are going to run your VM and participate in consensus, and they're going to stake some amount of your native asset. What you need to do there is effectively incentivize those validators to come on board. And so you have effectively like token emissions that are effectively paying them for the infrastructure costs that they have. On proof of stake networks, that is unavoidable, and it effectively is a form of crypto economic security. I don't know the analogy of cryptographic security when it comes to a proof of stake network. The closest analogy is maybe if you're looking at ZK rollups versus optimistic rollups, but it's maybe with this notion of like shared sequencers. Basically, you have only one sequencer nowadays for a given ZK rollup or optimistic rollup. I can imagine like there's some teams working on decentralizing that, having more than one. I can imagine them also having some native protocol token that helps bootstrap, say, a new rollup with multiple sequencers. But if you have the ZK flavor, that's probably a more robust model than an optimistic flavor, because you actually have it the state verified rather than having some
proven. Awesome. Guys, if you do have any other questions, please feel free to ask. We've got one here in the chat in terms of token valuation. What kind of tokens are DCFable? And what valuation methods do you use when a potential investment target pitches you their token?
Buy and burn is probably the most DCFable. It's where like some teams do this after, I don't know, like every quarter they say, we have $1 million in revenue, we'll like burn 20% of it, and so then you could model out a function. A lot of folks have done this around like BNB. Also with Ethereum post 1559, you could actually create some interesting financial models on there based on what you think your of the overall gas spend is going to be on Ethereum. So buy and burn, I think, is good. And then any kind of a token that potentially has a fee switch turned on. I think that's probably a way to do it. There's probably a minority of investors that do this actually. In terms of valuation methods, I think comparables is still by far the most widely used. That's why there's been so many investments in L1s, because there's so many tokens that are live that investors have some comparables and say, oh, if this token reaches the valuation that is, 1/10 of Polygon, then here's what we could stand to earn. But that's often not a good thing, because for applications, they sometimes struggle a lot more because there are no comparables. And so investors struggle with valuing it. I think that's why like very simple market standards are fine, very simple market standard dilutions and step ups at each round. I just wouldn't overcomplicate it. So that's typically how we look at it. It's how a lot of investors I talk to look at it.
Awesome. Want to touch a little bit about the fact you mentioned this earlier, kind of in your presentation. You're not recommending for many of the teams to be launching in these current conditions. What kind of is the primary differences that you're seeing in bear market versus bull market token launches? Has anyone done it well that you think they're not just lucky, but this is like a recent token launch that you've seen that kind of has been able to launch successfully? And perhaps what's one that hasn't, or the types of teams that you really think should just kind of wait a couple of years? And if you're the last one, if you're going to ask them to wait, how do they, in the short term, handle kind of launching their product, their platform, etc.?
Yeah, that was a lot. One clarification point: I think it's actually a really good time to launch in a bear, because that's well, assuming it's the right time for your project to do it. Okay. Which is like a separate question. But I think in bear markets, there's usually the people here are the ones who want to be here. So we actually think it's better if you launch. I mean, like mechanically towards the tail end of a bear market, mid to tail end is probably the sweet spot. Who knows like how to time this stuff? But I think like if someone's launching a token in the next year, I think it's actually a really good time to do it if it makes sense. In terms of
because you avoid the speculators, so you can ensure that the people that are actually buying the token actually care. But that just means you really have to ensure you have enough users and people within your community to be able to sustain it.
For sure. Yeah, and then your other.
Sorry, keep going.
Yeah. So which I said who did it right, or like what's different in.
Well, what's different? Who do you think has done it right? Who hasn't?
Yeah. What's different, I think, is just in terms of tokens in this cycle or in this stage of the market. We think there's actually a lot of cool things happening with NFTs. I don't think there was a lot of demand for that, like I'll call it an asset class. But I think there's demand in general, looking at a lot of different flavors of NFTs around PFPs, profile picture, like collections, to generative art, to like gaming projects. We've seen that are actually experimenting with using the NFT as the primary vehicle for value accrual. So they don't have a fungible token. On Snapshot, for example, you can have NFT voters vote, so they have NFTs as their governance token. I think that's a very interesting model that is particularly different. I think a lot of teams are also experimenting before launching a token. Before launching a fungible token, they will launch an NFT collection. And that's actually a really nice way to start to build community. And so that's been an interesting step that a lot of teams have introduced. This probably works better, maybe more for applications than infrastructure, but I think it's a really cool way to do it. Who has done it right? I think Magic was a cool one, biased because we're investors. It was an interesting, fair launch. Also, very nicely timed, happened after Loot, which is that NFT project, like the text, and they kind of launched after Loot. That was an example of something that did not have PMF, but just found the right audience and was able to almost like work with the community, with your community as partly like your co-owners to actually like drive the project to something that is actually a very cool idea, which is like this notion of a crypto native game publisher that provides a way for other game developers to launch on their platform and use like their token to effectively enable economic interoperability between games. That was probably more in like the urine sense, like you just got the tokens in the right hands at the right time. It's very hard to recreate, but very cool when you see that happen. Ones that don't do it right, I mean, I think there's still way too many L1s launching. Like, I don't consider us Ethereum maximalists, but I personally do not think you can scale with a singular monolithic blockchain. There's just too much to fit on it. I prefer the roadmap of 1,000 rollups. I don't want to name names, but there's still L1s that launch with 5% float, super high initial FTV. It looks good, but a ton of supply overhang, and people are just going to get hurt.
Thanks. Completely agree with that. And with that, we're right at 9 p.m. Dmitry, this has been really awesome. There's a lot of good content here. If people want to get in touch with you, any way to do that?
Twitter and Telegram. Dmitriy Berenzon on Twitter, or first letter of my first name and my last name, D Berenzon is my Telegram handle. But yeah, happy to chat about this. I know a bunch of folks had some questions here I didn't cover. Feel free to DM me on Telegram or Twitter. Happy to follow up on those.
And then a bunch of folks were asking if there's any chance of the deck being shared, and there's no pressure here if not.
I think so. Yeah.
Okay, awesome. Sounds good. So we can figure out the details of that later. Dmitry, thanks a ton for your time, and thank you everyone for joining and tuning in. I hope you guys have a good night.
Yeah, this is fun. Thanks, Gil. Thanks, everyone.
Thanks, Dmitry.
Cheers.